Real quick before we get into the numbers, because I know a lot of you are here for this exact reason, can you actually buy a Starbucks franchise? Like, could you personally walk into a bank, get a loan, and open your own Starbucks the way your uncle's buddy did with a Subway back in 2011? Short answer, no. And that's not me being difficult. That's just genuinely how the company is set up. And honestly, once you understand why, it tells you way more about how Starbucks actually makes money than if the answer had just been yes. So let's start with what this thing actually is. Starbucks isn't really selling coffee. I mean, obviously it's selling coffee. That's not some big twist. But the whole concept Howard Schultz built this on back in the early 80s was something he called the third place. Not your house, not your office, somewhere in between where you could sit, work, meet someone, kill 20 minutes, and the coffee was almost the excuse to be there. Schultz got the idea walking around Milan and Verona in 1983, watching how Italians used their neighborhood coffee bars, and he came back and basically said, we should be building that here. At the time, Starbucks had 3 stores, 3 in Seattle. Today, it's over 41,000 stores across roughly 88 countries. So whatever he saw in Italy, it clearly worked. Now here's the part that surprises people. Most of those 41,000 stores, just over half, are company operated, meaning Starbucks corporate owns them outright, hires the staff, sets the prices, keeps the profit. The rest, close to 48%, are what's called licensed stores. And this is where the franchise confusion comes from, because licensed sounds a lot like franchised, but it's structured really differently. When you see a Starbucks inside a Target or in an airport terminal or on a college campus, that's almost never some individual who walked in with a business plan and a loan. That's Target, that's the airport's retail management company, that's the university's dining services contractor, big institutional partners who already have the real estate, the foot traffic, and honestly the operational muscle to run a retail counter. Starbucks isn't handing the keys to a random investor. It's licensing the brand to companies that are already deeply embedded in places Starbucks wants a presence in but doesn't want to build from scratch. And here's how Starbucks actually gets paid on that arrangement, because it's a two-part thing. First, Starbucks sells the licensee the actual products, the coffee, the syrups, the cups, the branded everything, and takes a margin on that sale, basically like a wholesale markup. Second, on top of that, Starbucks takes a royalty percentage on whatever that licensed location actually rings up in sales. So Starbucks gets paid twice, once when the product ships out, and again every time a customer buys a latte at that counter. Meanwhile, the licensee is the one covering rent, payroll, equipment, all of it. Which is actually a pretty smart deal for Starbucks, because licensed stores technically show a lower gross margin on paper, but a higher operating margin since Starbucks isn't carrying nearly as much overhead on those locations. Its revenue is somebody else absorbing most of the risk. Let's actually get into the money now, because this is where it gets genuinely interesting. Fiscal 2025, Starbucks pulled in $37.2 billion in net revenue. Billion, with a B, company-operated stores, the ones Starbucks fully owns and runs, made up the overwhelming majority of that, somewhere around 82 to 87%, depending on the exact quarter you're looking at. Licensed stores, the ones we just talked about, contributed roughly 11 to 12%. And then there's a smaller third bucket called channel development. That's the bagged coffee you buy at the grocery store, the partnership products, stuff like the Starbucks brand you see on bottled frappuccinos in a gas station cooler. And that segment brings in around 5 to 6%. Now, one thing worth flagging, honestly, because I'm not here to just paint a shiny picture, in the most recent quarter reported, Q3 of fiscal 2026, consolidated revenue actually dipped about 1% compared to the year before, landing at $9.3 billion for the quarter. Part of that was Starbucks converting its China retail operations over to a licensed joint venture setup, which technically shifts how that revenue gets counted, even if the stores themselves are still running. But here's the part that's actually encouraging if you dig one layer deeper. Global comparable store sales, meaning sales at stores that have been open at least a year, were up 7.9%. In the US specifically, also up 7.9%. So the underlying business, people actually walking in and buying stuff, is doing better. The headline revenue number just got a little distorted by how China got restructured on paper. That's a pretty important distinction if you're actually trying to understand what's happening instead of just reading a headline. Operating margin currently sits around 7.9%. And it took a hit recently because Starbucks has been closing underperforming coffee houses and simplifying its store portfolio as part of something the company's been calling the Back to Starbucks turnaround. Brian Niccol took over as CEO in September of 2024, coming over from Chipotle, and a big chunk of his strategy has been going back to basics. Faster service, better in-store experience, cutting the stuff that was slowing baristas down and making the whole thing feel less like the cozy third place Schultz originally built, and more like an assembly line with mood lighting. Okay, let's talk about the actual product because the drink lineup is its own little economics lesson. Cup sizes first, since half the internet seems confused about this. You've got short, that's 8 ounces, hot drinks only. And it's kind of the secret menu size nobody orders, but it technically exists. Tall is 12 ounces, that's your standard smallest size most people actually order. Grande is 16 ounces, far and away the most popular size across the board. Venti is 20 ounces if it's hot, but jumps to 24 ounces if it's a cold drink because iced drinks need room for ice. And then there's Trenta, 30 ounces, cold only. Basically a small aquarium of iced tea or cold brew. Here's the thing about sizing that actually matters financially. The cost difference between a tall and a venti in terms of raw ingredients, coffee, milk, syrup, is genuinely small. A few extra ounces of milk and a splash more syrup costs pennies. But the price difference between those sizes is $1, sometimes more. That upsell moving someone from a tall to a grande is close to pure margin, which is exactly why baristas are trained and honestly incentivized to ask if you want to size up. And then you've got the signature stuff, the stuff that actually built the brand beyond just being a coffee shop. Pike Place Roast is the everyday drip coffee, named after the original Seattle location near Pike Place Market. It's the anchor, the reliable baseline product. Caramel macchiato, frappuccinos across a dozen flavor variations, those are the higher margin, more customizable drinks where the add-ons, extra shots, flavor pumps, alternative milk, all stack additional revenue onto a single order. But if you want the single best example of Starbucks turning a seasonal product into an actual cultural and financial event, it's the pumpkin spice latte. That drink alone, when it launches every fall, doesn't just sell coffee. It basically functions as a marketing campaign that people voluntarily participate in and post about for free. It's become shorthand for autumn itself in a huge chunk of pop culture. And that kind of organic, unpaid marketing reach is worth a genuinely enormous amount of money if you tried to buy it through traditional advertising instead. So pulling all of this together, here's the actual honest picture. Starbucks makes the overwhelming majority of its money the boring, straightforward way. Company-owned stores selling drinks directly to customers at high volume, with a menu engineered so that upsizing and customizing feels natural rather than pushy. The licensed store model adds a genuinely smart secondary revenue stream where Starbucks gets paid on product sales and royalties while somebody else, usually a large institutional partner, carries the operational risk. And the channel development side, the grocery store products, quietly extends the brand into millions of households that never even set foot in an actual Starbucks that week. 3 different revenue engines, 3 different risk profiles, all reinforcing the same brand. So back to the original question, can you personally franchise a Starbucks? No, not in the traditional sense, and now you actually understand why. Because the structure Starbucks built is arguably smarter than a normal franchise model for them specifically. It lets them keep tight control over the customer experience in the stores that matter most, while still expanding into airports, campuses, and grocery aisles through partners who already have the infrastructure to make that happen fast. If you're looking for a franchise you can genuinely walk into and own tomorrow, this isn't it. But understanding exactly why Starbucks chose this path over franchising tells you a lot about how a company scales without losing control of its own brand, which honestly might be the more valuable lesson here anyway. If this kind of honest, no fluff breakdown is useful to you, do me a favor and hit that like button. It genuinely helps this channel more than you'd think. Share it with somebody who's ever asked you if they should open a Starbucks franchise, because now you can actually give them the real answer instead of a guess. And subscribe if you want more of these, because we're breaking down a new business every single week, and there's a lot more ground left to cover.